Imagine that you could travel 10 years into past and invest in just one company, not the most famous company, not the company everyone was talking about, but the company that quietly and consistently created wealth year after year. Sounds simple, doesn't it? Yet, out of more than 1,500 listed companies in India, only a handful managed to achieve this extraordinary feat. According to Saurabh sir, 1 rupee invested in Asian Paints in 1991 became almost 300 rupees in 2016. That is the power of compound. But this book is not simply about making money. It is about understanding why some companies continue to grow stronger year after year, while thousands of others slowly disappear. Good businesses create profits, great businesses create wealth, extraordinary businesses create legacies. So, hello everyone, I'm Rudra Sharma, and together with my teammates Harshil, Hardik, and Par, we will take you through one of the most influential investing books written about India, The Unusual Billionaire. Today, we will connect the dots between greatness, opportunity, competitive advantage, innovation, long term compounding to understand what truly separates ordinary companies from extraordinary wealth. And to answer that question, let's begin with our first idea, that is greatness. The first question we need to answer is very simple. What exactly greatness is? According to the author, greatness is not simply rapid growth. Greatness is the ability to maintain high growth and high profitability simultaneously over a long period of time. Most companies eventually sacrifice one for the other. Some grow rapidly but become less profitable. Others remain profitable but stop growing altogether. As we can see on this slide, the black umbrellas represent the ordinary companies, while, while the red umbrella represents the exceptional ones. These businesses survive crises, competition, changing technologies, and economic slowdowns while continuing to create value. Astral Poly provides a perfect example. In 2009, a foreign currency exposure significantly affected the company's profit and its share price fell sharply. Most companies would have struggled to recover. Astral adapted, improved its operations, and continued growing. That is the difference between an ordinary company and extraordinary. Greatness is not about avoiding failure. It is about surviving failure and continuing to move forward. Now that we understand what greatness look like, let us move to the opportunity that these companies create. This naturally brings us to the next question. Why should investor care about these companies? The answer is simple, compounding. India is one of the fastest growing economies in the world, creating enormous opportunities for well-managed business. However, not every company can take advantage of those opportunities. Only businesses with strong leadership, disciplined execution, and durable business models can continue growing for decades. Page Industries is one such example. Through consistency, patience, operational excellence, the company generated exceptional returns for shareholders. This teaches us one of the most important lessons from the book, which is we do not need to own hundred of shares. Instead, we need the ability to identify only a few exceptional businesses and then allow time and compounding to do the rest. But an important question still remains. What allows these businesses to stay ahead of competitors for so many years? Let's find out. Next slide, please. Thank you. Why do some companies dominate entire industries while others disappear? The answer lies in competitive advantage. Every extraordinary company possesses a strength that competitors find difficult to replicate. This advantage can come from technology, data, distribution, network, brand value, customer trust, and operational excellence. HDFC Bank, for example, created one of the strongest banking networks in India through disciplined execution and superior customer service. Marico strengthened its market position through intelligent pricing strategies and deep understanding of consumer behavior. However, competitive advantages never last forever. Competitors learn, markets evolve, technology changes, therefore, continuous improvement becomes essential. The company that survives is not necessarily the biggest company. They are the companies that learns the fastest. And that brings us to the next slide because continuous improvement is in itself a form of innovation. When we hear the word innovation, we often imagine revolutionary products and groundbreaking discoveries. However, this book presents a very different perspective. Innovation is not always about inventing something completely new. Sometimes innovation simply means improving the existing systems repeatedly over a long period of time. Asian Paint transformed supply chain management long before the data analytics became common. Astral introduced CPVC pipes and created an entirely new market opportunity. Berger Paints improved the operational efficiency and strengthened its dealer network through technology. Over time, these small improvements create enormous advantages. This is precisely where innovation is compounding come together. Small actions repeated consistently over many years eventually produce extraordinary outcomes. And with that, we arrive at the central idea of entire. As we conclude, one idea connects every chapter of this book is great businesses are not built overnight. They are built one decision at a time. Asian Paints, HDFC, Page Industries, Marico, Berger Paint, Astral Poly. They are from different industries, different business models, different strategies, yet all of them followed the same principles, which are consistency, discipline, innovation, adaptability, and patience. Perhaps that is the greatest lesson of the unusual billion. Extraordinary wealth is rarely created through extraordinary actions. More often, it is created through ordinary actions repeated consistently over a period of time. As Steve Jobs once said, great things in business are never done by one person. They are done by a team of people. On that note, I would like to hand over the presentation to Hardik. Thank you.
Thank you, Rudra. So, most companies think of greatness as a single breakthrough or a period of rapid growth. But true market leaders, like the unusual billionaires, view it differently. Today, we are looking at how few legendary Indian companies used unique techniques in supply chains, distribution, and management to stay at the top. Let's start with Asian Paints. We usually think of a brand as a logo or an ad, but for this company, the brand is actually their supply chain. They did something that most companies in the industry wouldn't dare. They removed the middleman. Instead of using wholesalers or large distributors, they deliver paint directly to over 70,000 small dealers. Because dealers know that they can get fresh stock within hours, they trust the company and keep their products displayed. This availability and freshness build a type of unshakable loyalty from both the shopkeeper and the customer, securing a dominant position in the market. Now, moving towards the next slide. Thank you. While Asian Paints mastered the supply chain, other winners like Berger Paints and Marico found that their own distinct paths to wealth. Berger Paints took an approach of focused challenger. Instead of trying to be everything to everyone or chasing unrelated businesses, they started discipline. They focused specifically on expanding their dealer network within their decorative paint section. By avoiding distraction, they built a powerful specialized presence that is hard to disrupt. Marico, on the other hand, built its moat through rural reach. They established a massive distribution network that goes deep into the heart of rural India, places where many other brands simply don't go. By being the only reliable option in the remote areas and combining that with a strong brand name, Marico gained immense pricing power. Moving towards the next slide. Success is one thing, but longevity is another. The final piece of the puzzle for these companies is their shift towards professional management. Many businesses fail to scale because their founder tries to control everything forever. The most successful companies make a deliberate choice to transition from a founder-led structure to one run by experienced and qualified executives. So, this shift is vital for mainly two reasons. First, this separates the ownership from the management, which leads to the objective and data driven decisions. Second, it ensures the company lives on and continues to grow long after its original creators are gone. So, to finally wrap things up, the secret to becoming an unusual billionaire isn't magic, it's about systems. Whether it's the high speed supply of Asian paints, the rural dominance of Marico, or the professional discipline of expert leadership, these companies prove that the best way to win is to build a system that is impossible for others to copy. This disciplined focus is what creates the long term compounding that turns small sums into extraordinary wealth. Now, I would like Harshil to continue.
Thank you, Hardik. Now, I will explain the concept of capital allocation. Capital allocation simply means how a company uses the profit it earns. A successful company doesn't just focus on earning profit. It also focuses on using those profits wisely. Let's compare HDFC Bank and Axis Bank. HDFC Bank followed a disciplined approach. It reinvested most of its profits into technology, digital capabilities, and expanding its branch network. Instead of paying large dividends, it preferred to invest in long term growth. Axis Bank also invested for growth, but its focus was on building a strong retail banking franchise. It maintained a balanced dividend policy and also made some strategic acquisitions, such as acquiring Citibank's consumer business. Another important difference is that their acquisition strategy. HDFC Bank generally avoided large and risky acquisitions. It preferred building capabilities internally. Axis Bank, on the other hand, used acquisitions only when they supported its long-term strategy. So, the key takeaway is companies simply don't simply distribute profits or chase every acquisition opportunity. They invest capital where the highest long-term returns. It can generate the highest long-term returns. Next slide, please. Now, let's move on to management philosophy. The companies in this book follow three important principles. The first is deep moats. A deep moat means building strong competitive advantages that competitors cannot easily copy. This helps the company maintain growth for many years. The second principle is capital allocation. Management carefully decides where every rupee should be invested, whether it's technology, expansion, or new opportunities. Every decision is taken with a long term perspective. The third principle is avoiding hubris. Hubris means overconfidence or excessive ego. Many companies fail because the management becomes overconfident and starts making poor decisions. These companies avoid that mistake. They start disciplined focus on their strength and think about long-term value instead of short-term recognition. Together, deep modes, capital allocation, and avoiding hubris form the foundation of long-term business success. Next slide, please. Now, finally, the customer understanding. Let's look at customer understanding. Every successful company understands its customers deeply. For these businesses, customer understanding is not just a marketing activity, it is a part of overall strategy. They continuously listen to the customer feedback, they improve their products, their services, and the overall customer experience. Their goal is not only to satisfy their customers, but to exceed their expectations. By doing this, they build trust, customer loyalty, and long term relationships. The further presentation will be continued by Parth. Thank you.
Thank you, Harshit. Now I can explain a financial performance. Financial performance is the best way to judge whether a company is creating long-term value. Great company don't just earning profit for 1 or 2 years. They perform consistently over a long period. First point is high ROCE. The company in this book maintain ROCE of more than 50% every year. This means they use their capital very effectively and generate strong return. And the second point is revenue growth. The company achieved double-digit sales growth for many years. This shows that customers' demand and business expansion remained strong over the time. Third point is EPS. Their EPS compounding at more than 20% annually, which means shareholders' wealth growth consistently year after year. Next topic is competition. The book says that many companies fail not because of competition, but because of their own mistake. The unusual billionaires avoid this mistake. First, they avoid unrelated diversification. They stay with their circle of competence, interest of uh, entering business they do not understand. Second, they avoid empire building thought acquisition. Instead of buying companies just for size of frame, they make careful and disciplined decisions. Third, they avoid debt-full growth. They do not take excessive loan just to show fast growth because high debt increase financial risk. Finally, they avoid promoter fiefdoms, where promoter treat the company like their personal property. Instead, they focus on good corporate governance and protect shareholder interest. And next topic is corporate culture. Corporate culture is a invisible strength of companies. It is the way employees think, behave, and make decisions every day. A strong culture is different for competitors to copy. Even if competitor copy product or strategy, they cannot easily copy the company's value and mindset. The first characteristic is value overrule. Employees are guided by strong values instead of depending only on strict rules. The second characteristic is long-term originator. These companies focus on creating sustainable value instead of chasing short-term profit. Now I can conclude this all point. The unusual billionaire teaches that long-term success is never achieved by luck. It is built through discipline, patience, and consistently over many years. The company discussed in this book have created sustainable wealth because they focus on strong fundamental instead of short-term market trend. They generate high return on capital, maintain consistency, revenue and profit growth, and avoiding unnecessary debt and risk diversification. Another important lesson is that great companies are built by a great management, honest leadership, ethical business practices, and a strong corporate culture help this company earn the trust of customers, employees, and investors. The book also explains the power of compounding. Even a small improvement in business performance, when maintained consistency for many years, create an extraordinary result. This is why this company has been able to deliver exceptional shareholders return over the long term. As investor, we should not only look at a company profit, but also its management quality, competitive advantage, financial disciplines, and a long-term visions. These factors help identify business that can continue growing for many years. My opinion, the, the biggest takeaway from this book is the consistency in ultimate competitive advantage. Companies that focus on quality, discipline, innovation, and a long-term value creation become a true wealth creator. Thank you.